Welcome, everyone. I'm excited to kick off our presentation today. We'll be exploring the end-of-course review for real estate principles. In this session, we'll go over the key concepts and topics we've covered so far. So, get ready for a quick recap that will reinforce your understanding and prepare you for the next steps. Let's get started. Understanding these market characteristics is crucial for making well-informed real estate decisions. Whether you're investing, selling, or simply evaluating property values in your area, knowing what makes this market unique is essential. No two properties are exactly alike. Each parcel of real estate has its own set of characteristics, such as location, size, age, condition, and features. This diversity makes it challenging to compare properties directly or to standardize valuations across different properties. When we talk about heterogeneous products, we're highlighting that real estate is very different from stocks or bonds. Transactions often take a lot longer, sometimes weeks or even months to complete. Plus, the process involves significant transaction costs and complex legal procedures, which can be quite different from other investment types. Another key point is lower liquidity. Unlike stocks that can be sold quickly, real estate assets are less liquid. The value of a property and the market conditions can vary greatly depending on where the property is located. Demand and supply are tied to specific neighborhoods or regions, not just a national or global market. This brings us to localized markets. The fundamental characteristic of real estate is that it's very much tied to its specific location. This local nature influences property values, investment strategies, and how the market behaves overall. Understanding these primary characteristics helps us grasp how the real estate market functions differently from other financial markets, and why careful analysis is so important when making decisions in this space. Understanding fixture determination is crucial because it helps prevent disputes during property sales. Basically, we want to know whether an item is considered part of the property or just personal property. Items like chandeliers, built-in appliances, and custom shelving are usually fixtures, meaning they've become part of the property. On the other hand, furniture and portable appliances typically stay personal property and aren't included in the transfer. Determining if an item has become a fixture involves assessing whether it is included in the real property transfer. This is what we call the final classification. To do this, we look at whether removing the item would cause damage to the property or the item itself. If removal would cause damage, it indicates that the item is permanently attached and thus likely a fixture. This is known as the damage assessment. Another key step is the method of annexation test, where we examine how the item is installed or affixed. We ask whether the attachment is permanent and how it's attached. This helps us understand whether the item has truly become part of the property. Initially, an item starts as personal property, owned separately from the real estate. But once it's attached in a permanent way, it can become a fixture. And that's where the fixture determination comes into play. It's about understanding the method of annexation, which ultimately helps us decide if an item is included in the property transfer. All of this ties back to the overall goal of property law, to clearly define what is included in a sale and avoid potential conflicts. Now, let's dive into the concept of fee simple absolute. This type of ownership offers the maximum benefits and rights to the owner, and it's actually the most complete form of property ownership recognized in real estate law. When property is transferred, it's usually presumed to be fee simple absolute unless there's a clear limitation stated. This estate is inheritable, meaning it can pass to heirs, and it's perpetual, continuing indefinitely through successive generations. In contrast, we have other types of estates, such as leasehold estates, which are temporary possessory interests without ownership rights. Life estates, which are limited to an individual's lifetime and then transfer to someone else. And fee simple conditional estates, which are ownerships that depend on specific conditions and can revert if those conditions aren't met. Now, a key part of fee simple absolute is the bundle of rights it includes. Think of these as the fundamental privileges that come with ownership. things like the right to devise or pass the property to heirs, the right to encumber, such as mortgaging or creating liens, the right to transfer, meaning sell, gift, or convey the property, the right to exclude, which allows owners to prevent others from entering or using the property, the right to use or enjoy the property within legal limits, and of course, the right to possess or occupy the property exclusively. In summary, fee simple absolute is the highest and most complete ownership interest you can have in real estate. It grants the owner the fullest set of rights to possess, use, and transfer the property freely, with no limitations or conditions. This concept is fundamental because it forms the basis of most property transactions and ownership rights we deal with in real estate. Let's take a closer look at the government's powers related to property. First, taxation is a key power. The government has the right to levy taxes on property to fund public services that benefit everyone. Then there's escheat, which happens when property reverts to the state if an owner dies without heirs or a valid will, ensuring property doesn't remain unclaimed. Next, police power allows the government to regulate how property is used, think zoning laws or building codes, to protect public health, safety, and welfare. Importantly, these regulations are applied without compensation to the property owner. Now, it's crucial to distinguish these powers from other government powers. When the government takes property, owners are entitled to fair market value. This is called just compensation, determined through appraisal and negotiation. If an agreement isn't reached, courts step in through condemnation proceedings to decide the appropriate amount. The reason for this is the public use requirement, rooted in the Fifth Amendment's Takings Clause, which states that private property can't be taken for public use without just compensation. This clause ensures fairness while still allowing the government to carry out essential projects like building highways, schools, parks, or utilities. This constitutional foundation is known as eminent domain, the power that permits federal, state, and local governments to acquire private property for public purposes, as long as they pay just compensation. It strikes a balance between public needs and protecting individual property rights. So, in summary, these powers, taxation, escheat, police power, and eminent domain, are essential tools that enable the government to serve the public interest while respecting property owners' rights. When we look at different types of deeds, it's important to understand what each one implies about the grantor's ownership and warranties. First, the bargain and sale deed indicates that the grantor does own the property, but it doesn't provide any warranties against encumbrances. That is, any liens or claims against the property. Next, the special warranty deed offers some protection, but only during the period the grantor owned the property, not before. So, it warrants that there were no defects during their ownership, but not prior. Then we have the quitclaim deed, which is the most limited. It simply transfers whatever interest the grantor has, if any, without offering any warranties or guarantees. This type is often used for quick transfers or clearing up title issues. Now, when a grantor is transferring property, they will usually need to execute additional documents to perfect the title. These include several important covenants. The covenant of further assurance means the grantor will take further steps if needed to perfect the buyer's title. The covenant of warranty forever guarantees that the buyer's possession won't be disturbed by future title claims and that the grantor will defend the title against lawful claims. The covenant of quiet enjoyment promises that the buyer will enjoy the property without interference from undisclosed liens, easements, or restrictions. The covenant against encumbrances assures that there are no undisclosed encumbrances burdening the property at the time of transfer. The covenant of right to convey confirms that the grantor has the authority to transfer the property without restrictions. Lastly, the covenant of season guarantees that the grantor owns the property and has the legal right to convey it. Among all these, the general warranty deed is considered the most comprehensive. It provides the broadest protections, covering the entire chain of title from the property's origin to the present. This makes it the gold standard in real estate transactions, giving the buyer the most confidence that their ownership is secure and free from undisclosed issues. let's talk about the importance of an accurate point of beginning, or POB, in boundary surveying. Establishing the POB correctly is crucial because it helps prevent boundary disputes and ensures that the property title is clear. Professional surveyors use precise tools like GPS coordinates and recorded monuments to establish and verify this starting point. It's essential to understand that the POB isn't related to elevation, high points on the land, or arbitrary geometric centers. Instead, it must be described in a way that future surveyors can easily locate it, so the boundary stays consistent over time. When conducting a survey, the goal is to return exactly to the POB, creating a closed polygon that clearly defines the entire parcel without gaps or overlaps. This involves starting at the POB and then proceeding around the property, using directional bearings. These are angles and distances to define each boundary line. The POB is usually established at a permanent, identifiable landmark or monument, such as an iron pin, a concrete marker, a large boulder, or even an intersection of roads. This fixed reference point is vital because, in legal property descriptions, it serves as the anchor for the entire metes and bounds description. It's the key point that ensures the property boundaries are identified precisely and legally. So, in summary, the point of beginning is the cornerstone of accurate boundary surveys. It's what allows us to define property lines clearly, maintain boundary integrity over time, and avoid future disputes. Now, let's talk about some of the mechanisms that provide flexibility within zoning regulations. Variances, conditional use permits, and rezoning applications are key tools that allow local governments to adapt to specific circumstances. They help when strict application of zoning rules would cause undue hardship, or when circumstances in a community change unexpectedly. These mechanisms ensure that zoning remains responsive and flexible to actual needs. Moving on to the legal basis for zoning, it all stems from state enabling acts. These acts delegate police powers to local governments, empowering them to promote orderly development and protect the character of their communities. Essentially, zoning is a way for local authorities to manage land use in a way that benefits everyone. It's important to distinguish zoning from eminent domain. Unlike eminent domain, which involves taking property ownership and requires just compensation, zoning simply restricts how property can be used. Property owners still hold the title, but they must follow certain use regulations. Zoning doesn't transfer ownership. It's about regulating land use. Specifically, zoning doesn't involve taking property or paying compensation. Instead, it requires permits and reviews before any construction or use changes happen. Zoning also regulates aesthetics, parking requirements, signage, and set standards for building height, setbacks, lot coverage, and density. It divides communities into districts: residential, commercial, industrial, agricultural, each with designated permitted uses. In summary, zoning is one of the most common ways governments exercise police power. It enables municipalities to regulate land use in a way that protects public health, safety, morals, and the overall welfare of the community. This authority shapes how our communities develop, without needing to compensate property owners, but always with the goal of fostering organized, safe, and vibrant neighborhoods. Understanding linkages is essential because they help explain why certain locations command premiums and how they guide our investment decisions. When properties have strong multiple linkages, they tend to have higher values and enjoy greater market stability over time. Now, let's talk about synergy. This is the value created when different uses or functions enhance each other's success simply through proximity. Think of a tech company near a university. It benefits from access to talent and innovation. Then there's agglomeration, which refers to the clustering of similar businesses. This creates specialized districts like tech corridors or vibrant restaurant rows, offering benefits like shared resources, a skilled workforce, and increased foot traffic. It's important to distinguish these concepts from related factors. For example, proximity to quality schools, hospitals, universities, and government facilities attract specific demographics and economic activities, helping to create distinct market segments. Institutional linkages are another key aspect. Good connectivity to highways, public transit, airports, and major roads makes a location more accessible, facilitating the movement of people and goods. This accessibility significantly boosts a property's value for various uses. Transportation linkages also matter greatly. Access to shopping, dining, entertainment, and other services enhances the appeal of both residential and commercial properties. When locations are convenient, consumer behavior shifts towards favoring those areas, increasing desirability. Retail linkages are especially important near job centers, business districts, and major employers. They directly influence residential property values because shorter commutes and easy transit options make these locations more attractive for residents. Finally, employment linkages reflect how proximity to key destinations like employment hubs impacts property values and market desirability. When people can easily access work and amenities, the demand for those locations increases, driving up prices. In summary, these linkages, whether institutional, transportation, retail, or employment, are all interconnected. They create a network of economic demand that fundamentally shapes property values and market dynamics. Recognizing and understanding these linkages enables us to make smarter investment decisions and better assess location premiums. Let's delve into the concept of conformity first. Essentially, maximum value for a property is achieved when its characteristics harmonize with the standards of the neighborhood. When properties blend well within their context, they tend to be valued higher. Moving on to contribution. This principle emphasizes that the value added by any improvements on a property equals the contribution those improvements make to the overall property value. In other words, not every upgrade necessarily increases the value equally. It depends on how much they contribute to the property's worth. Next is substitution. This principle states that the value of a property is limited by the cost of an equally desirable substitute. If there's a similar property available at a lower price, it caps how much a buyer is willing to pay for your property. Now, let's contrast these principles. Turnaround properties, for example, are valued based on their potential for improvement. Development sites, on the other hand, are priced considering future absorption, meaning how quickly they can be developed and sold or leased. Additionally, properties are often valued based on projected net operating income growth, which reflects anticipated income increases over time. This is where the principle of anticipation really comes into play. It explains why investors are willing to pay premium prices for properties in emerging neighborhoods, or for development sites with future potential, or income properties with strong lease profiles. Essentially, investors are focusing on the future benefits, not just the current state. This principle drives much of our analysis and decision-making. For example, when we prepare pro forma analyses, we're estimating future income, appreciation, and overall value. These projections guide our investment choices. Speaking of implications, investors are interested in the projected proceeds from eventual sales, including equity buildup and market gains. This is what we refer to as future sale, the expected increase in property value driven by market trends, improvements, or development potential. Similarly, appreciation relates to projected increases in rental income, lease escalations, and the overall revenue-generating capacity of the property over the holding period. Finally, income potential is reflected in today's property value, which is essentially the present worth of all anticipated future benefits, discounted back to current dollars. To sum up, the principle of anticipation is fundamental because it recognizes that property value isn't just about past events, but about expectations of future income, use, and benefits. This forward-looking perspective is what truly drives real estate valuation and investment decisions. Now, let's talk about how real estate professionals often approach market analysis by combining primary and secondary data. Secondary data refers to information that's been collected by others for different purposes, like government reports, MLS data, demographic databases, or published studies. It's usually less expensive and faster to obtain, which makes it very appealing. However, it's important to remember that secondary data might not always perfectly match your specific research needs or reflect the most current market conditions. On the other hand, primary data is original information you gather directly through your own efforts. This includes methods like field measurements, inspections, direct observations of property conditions, or transactions. It also involves focus groups, personal interviews, and surveys targeted at specific populations. Primary data is particularly valuable when existing sources don't fully answer your questions or when you need the most up-to-date information. Now, let's compare the two. Secondary data has its advantages. It can provide useful context and benchmarks, and it's generally quicker and cheaper to access. But it also has downsides, such as potential biases in how it was collected, limited sample sizes, and sometimes a mismatch with your specific research needs. It might also require expertise to interpret correctly and may not always reflect the latest market realities. In contrast, primary data gives you direct control over the quality and relevance. You can tailor your data collection methods to precisely fit your project, making it easier to address specific property issues or market segments. For example, you might conduct personal interviews with market participants or focus groups to explore attitudes and preferences, or distribute surveys to target populations. Essentially, primary data fills in the gaps left by secondary data, giving you more accurate, current, and relevant insights. Combining these two types of data can give you a comprehensive understanding of the market, leveraging the strengths of each while compensating for their weaknesses. This integrated approach is key to making well-informed decisions in real estate. Let's talk through the key points here. First, it's important to remember that we never adjust the value of the subject property itself. It remains our constant reference point. Instead, all adjustments are made to the comparable sales to make them more similar to the subject property. Think of it as leveling the playing field, so we're comparing apples to apples. The idea is that the comparable is adjusted to reflect what it would have sold for if it shared the same characteristics as the subject. This is crucial because it creates an equivalency between the two properties and allows us to make a meaningful comparison. Now, let's look at a quick example. Suppose we have a comparable sale that sold for $350,000, and it has a pool, which the subject property does not. Since the comparable is superior due to the pool, we subtract the value of the pool, say $25,000, from the comparable's sale price. This adjustment gives us an adjusted price of $325,000, which is more comparable to our subject property. The key principle here is that the adjustment is applied to the comparable, not the subject. If the comparable is better or has features the subject lacks, we subtract value. If it's inferior, we add value. This systematic approach ensures we're accurately reflecting differences in features like size, condition, location, amenities, or sale date. To do this systematically, we quantify the differences, either in dollars or percentages, using methods like market extraction, paired sales analysis, or regression techniques. This helps us determine exactly how much to adjust each comparable sale. So, in summary, the process involves comparing features, deciding whether to add or subtract value based on how the comparable differs from the subject, and then making those adjustments to arrive at a fair, comparable value. This methodology is the backbone of the sales comparison approach in property valuation. Understanding the difference between reproduction and replacement cost is crucial for accurate property valuation and making sure you have the right insurance coverage. This is especially important for unique or historically significant properties. When we talk about updated building systems, these are generally the standard for most appraisals today, more economical and using modern materials and methods. These systems are designed to provide the same utility as the original structure, but often at a lower cost. Now, replacement cost refers to maintaining the original specifications of a building. It's often used for historic properties because it aims to replicate the original design and features, even if that means a higher cost. Replacement cost includes obsolete features, like old mechanical systems or architectural details that are no longer standard. Reproduction cost, on the other hand, is a bit different. It accounts for outdated elements, things like plaster walls, single-pane windows, or antique mechanical systems that match the original construction. The goal here is to create an exact replica of the building using the same materials and techniques, even if those are no longer efficient or common today. This distinction is especially important for landmark buildings, historic homes, and structures with significant architectural value, where preserving authenticity and original character is essential. Insurance companies often require reproduction cost estimates to ensure adequate coverage. Reproduction cost involves replicating every detail, material, and construction method used in the original structure, regardless of whether those methods are still standard practice. This makes it particularly relevant for specialized or historic properties. So, in summary, reproduction cost is about creating an exact duplicate, including all the original features, even those that are obsolete, while replacement cost focuses on modernizing and maintaining the building's utility with current standards. Both are vital tools in appraisals, especially when dealing with unique or historic properties. Accurate PGI estimation requires thorough market research and a realistic assessment of the property's competitive position. This figure serves as the baseline for all subsequent income approach calculations, making precision essential for reliable valuation conclusions. Potential gross income, or PGI, represents the theoretical maximum income a property could generate if it were fully leased at current market rental rates, without any vacancy, collection losses, or concessions. In reality, we will need to adjust this number downward to account for those factors, which brings us to effective gross income, the next step in the process. To support our PGI estimate, it's important to record the market data sources we've used, including comparable properties and the rationale behind our rental rate conclusions. This helps establish credibility and transparency in our valuation. When calculating potential gross income, we multiply the market rental rates by the number of units or spaces, and then add other income sources, such as parking fees, laundry, storage, pet fees, or utility reimbursements. These additional income streams can significantly impact the total potential income. Next, we need to catalog all income-generating components of the property, including residential units, commercial spaces, parking areas, storage facilities, and other ancillary sources. An accurate inventory ensures we don't overlook any income streams. To determine the appropriate rental rates, we research comparable rental properties in the area. We consider factors like location, size, amenities, and lease terms to establish competitive and realistic rental figures. Finally, the income approach kicks off with estimating PGI, the total income the property could produce if everything were fully leased at current market rates. This foundational step defines the maximum revenue capacity of the property and is crucial for developing a reliable valuation. Accurate PGI estimation requires thorough market research and a realistic assessment of the property's competitive position. This figure serves as the baseline for all subsequent income approach calculations, making precision essential for reliable valuation conclusions. Potential gross income, or PGI, represents the theoretical maximum income a property could generate if fully leased at current market rental rates, with no vacancy or collection losses. In reality, actual income will be reduced by factors like vacancies, collection losses, and concessions, which lead us to the next step, calculating the effective gross income. To support our PGI estimate, it's important to record our market data sources, the comparable properties used, and the rationale behind our rental rate conclusions. This helps ensure our valuation is credible and grounded in solid market evidence. When calculating potential gross income, we multiply the market rental rates by the number of units or rentable spaces. We then add other income sources such as parking fees, laundry, storage, pet fees, or utility reimbursements. This comprehensive approach gives us a clear picture of the property's maximum income potential. Next, we need to catalog all income-generating components: residential units, commercial spaces, parking, storage, and any other ancillary income sources. This detailed inventory helps us understand the full income capacity of the property. To determine accurate rental rates, we research comparable rental properties in the area. When doing this, we consider factors like location, size, amenities, and lease terms to establish competitive and realistic rental rates. Finally, the income approach begins with estimating PGI, the total income the property could generate if fully leased at current market rates, without any vacancy or collection losses. This step is fundamental because it sets the maximum revenue capacity of the property and forms the basis for further calculations. And expense control to increase property value. What this really means is that, by carefully managing our costs, we can improve the overall financial health of the property. It's about making smart decisions, cutting unnecessary expenses while investing wisely in areas that add value. When we control expenses effectively, it enhances profitability, which in turn boosts the property's market value. This ties directly into our overall strategy of maximizing returns for investors and ensuring sustainable growth over the long term. So, keeping expenses in check is not just about saving money. It's a key driver of increasing property value and achieving our broader goals. The note and security instrument work together in real estate financing. The note creates the debt obligation, which is essentially the borrower's promise to repay the loan. On the other hand, the mortgage or deed of trust provides the lender with security interest in the property. This security interest acts as collateral to ensure the lender can recover the loan if the borrower defaults. Both documents are absolutely essential because they serve different but complementary purposes. The security instrument, like a mortgage or deed of trust, secures the debt by creating a lien on the property. This means the property itself becomes collateral for the loan. However, these documents do not create the debt obligation, they merely secure it. The actual debt and personal obligation are created by the promissory note. Now, the promissory note is the key document that creates the debt and personal obligation. Think of it as an IOU, a formal promise to repay the money borrowed, with interest, under specific terms. It includes important details like the repayment schedule, interest rate, maturity date, and the total loan amount. The note also defines acceleration clauses, which can trigger full repayment if certain conditions are met, and may include prepayment provisions and penalties. It's important to highlight that the promissory note establishes personal liability. This means the borrower remains obligated to repay the loan even if they lose the property or if the property is no longer in their possession. The note is a negotiable instrument, so it can be sold or transferred, adding flexibility in the financial market. In terms of legal characteristics, the note contains the borrower's promise to repay unconditionally, with a specified maturity date for the final payment. It sets out the payment schedule, how much, how often, and for how long payments will be made, and the interest rate, which is the cost of borrowing expressed annually. The total loan amount borrowed, or principal, is also clearly stated. To sum up, the promissory note is the fundamental financial instrument in real estate lending. It creates the borrower's personal promise and legal obligation to repay the loan, making it central to the entire financing process. Without it, the security interest provided by the mortgage or deed of trust wouldn't be meaningful, because there would be no clear debt obligation. Let's take a closer look at the practical impact of these theories. They really influence foreclosure procedures, redemption rights, and how quickly lenders can recover property after a default. In lien theory states, foreclosure usually requires a court process, which provides extra protections for the borrower. Now, in lien theory states, the borrower holds what we call equitable title. This means they have the right to possess and use the property, build equity, and enjoy the benefits of ownership. The lender's lien just acts as security for the loan. It doesn't transfer ownership rights. Interestingly, very few states follow this approach, but it does give lenders enhanced remedies. In this setup, the legal title stays with the borrower until a default occurs. There's also a hybrid approach, sometimes called intermediate theory, where the borrower initially holds the title, but if they default, the title transfers to the lender. This combines elements of both theories and depends on the payment status. This intermediate or hybrid approach is used by a minority of states. Foreclosure can even be non-judicial in some cases, and the borrower still holds an equitable interest, while the lender holds legal title. When the loan is fully repaid, the legal title goes back to the borrower through reconveyance. Now, moving to title theory states, these are followed by most of the U.S. states. Here, the foreclosure process is typically judicial, and the lender is considered a secured creditor. The borrower remains the legal owner throughout the loan, holding both legal and equitable titles. The lender only has a security interest, a lien, so the borrower maintains possession and ownership rights unless they default. Finally, understanding whether a state follows lien theory or title theory is crucial because it directly affects ownership rights, foreclosure procedures, and the legal remedies available to both parties. Recognizing these differences helps us better grasp the legal landscape during the lending process. Let's talk about ARMs, or adjustable rate mortgages, and when they can be particularly attractive. They tend to make sense when interest rates are expected to decline, or if you're planning to own the property for a short period. They can also be beneficial if your qualifying income is limited, since initial payments might be lower. However, it's important to remember that if rates rise, your payments could increase, so borrowers need to be prepared for that possibility. Now, moving on to reverse mortgages. This option allows seniors to convert their home equity into income without having to make monthly payments. The loan is typically repaid only when the home is sold, providing a way to tap into assets without regular payments. Next, there's the balloon mortgage. It features regular payments, usually similar to a traditional loan, but at the end of the term, there's a large final payment that covers the remaining balance. This can be useful if you expect to have a lump sum available later on. The fixed-rate mortgage, on the other hand, keeps the interest rate constant throughout the entire loan term, giving you payment stability and predictability. That's often appealing for long-term planning. When comparing these types of loans, it's important to understand how ARMs work. The new rate is calculated as the index plus a margin, and this can be subject to caps to limit fluctuations. At each adjustment date, the lender recalculates your payments based on the current index value, your remaining balance, and the remaining term of the loan. Regarding rate adjustments, there are caps in place to protect borrowers. The periodic cap limits how much the rate can change at each adjustment, while the lifetime cap restricts the total increase over the life of the loan. There's also an initial cap that limits the first adjustment, helping prevent sudden payment shocks. The adjustment period refers to how often your rate can change, monthly, annually, or at other intervals. The initial rate is often set lower than the market rate, serving as a teaser. The margin is a fixed percentage added to the index to determine your rate, and the index itself is an external benchmark like SOFR, Treasury rates, or LIBOR's successor. All these components, index, margin, caps, adjustment period, work together to determine your ARM's interest rate and payments over time. An ARM adjusts periodically based on changes in the specified index, which means your monthly payments can fluctuate. While ARMs can offer initial rate advantages, they also transfer some interest rate risk to borrowers, so it's important to consider that when choosing this type of loan. Now, let's take a look at the role of local lenders. These are the institutions that originate loans directly to borrowers in the primary market. Essentially, they are the first point of contact for someone looking to buy a home and secure a mortgage. Moving on to the VA, or Department of Veterans Affairs. The VA guarantees loans for veterans, which means they back these loans to help veterans get favorable terms. However, it's important to note that the VA itself doesn't participate in the secondary market. It's mainly focused on guaranteeing the loans at the primary level. Similarly, the FHA, or Federal Housing Administration, plays a key role by ensuring loans against default. This insurance provides lenders with confidence that they will be protected if a borrower fails to repay. But again, the FHA doesn't buy or sell mortgages, so it stays focused on insurance rather than the secondary market activities. Now, let's talk about how Fannie Mae fits into all of this. Fannie Mae is a distinguished entity because it provides a reliable secondary market for mortgages. By doing so, it enables lenders to originate more loans because they know they can sell those loans afterward. This process helps reduce geographic disparities in mortgage availability, meaning more people across different areas can access home financing. Standardizing lending practices is another key benefit. When Fannie Mae is involved, lenders follow consistent guidelines, which promotes fairness and efficiency. Plus, by supporting a competitive environment, Fannie Mae helps keep interest rates nationwide at reasonable levels. It's important to understand that Fannie Mae is a government-sponsored enterprise, or GSE. While it has a public mission and is overseen by the government, it operates as a private company owned by shareholders. During the 2008 financial crisis, it was placed under government conservatorship to stabilize its operations. Now, let's look at how Fannie Mae's activities impact the market. Investment funds generated through its operations flow back into the mortgage market, which means more funds are available for new loans. This cycle helps sustain and grow the housing finance system. A key part of Fannie Mae's function is securitization. Mortgages are pooled together and converted into mortgage-backed securities, which are then sold to investors. This process spreads the risk and provides liquidity to the market. Fannie Mae also buys qualifying conforming loans from lenders, essentially replenishing their lending capital. This means lenders have more funds to originate new loans, keeping the entire system active and fluid. When banks and mortgage companies originate loans, they use their available funds to lend to homebuyers. Then, Fannie Mae steps in by purchasing those loans, which keeps money flowing in the secondary market. So, in summary, Fannie Mae plays a pivotal role in the secondary mortgage market by purchasing mortgages from lenders. This provides liquidity, supports continuous lending, and ultimately helps more people access homeownership across the country. Now, let's take a closer look at the loan underwriting process. Automated underwriting systems, or AUS, like Desktop Underwriter and Loan Prospector, use sophisticated algorithms to quickly evaluate loan applications. These systems help streamline the initial review, but when situations are more complex, a manual underwriter's judgment is still essential. In terms of the process flow, it starts with origination, which is the initial creation of the loan. This includes the application, processing, and collecting all necessary documentation. After the loan is closed, the servicing phase begins, involving ongoing administration such as collecting payments, managing escrow accounts, and providing customer service. It's important to distinguish these core processes from related ones. For example, the loan-to-value ratio, or LTV, compares the loan amount to the property's value. A lower LTV means less risk for the lender and might even eliminate the need for private mortgage insurance, or PMI. Then there are debt-to-income ratios. These are crucial standards. The front-end ratio, which looks at housing costs, is typically kept at or below 28% of gross monthly income. The back-end ratio, which considers all debt obligations, usually stays at or below 36%. These ratios help ensure borrowers can comfortably handle their monthly payments. Moving on to underwriting standards, one key step is ordering an appraisal. This determines the market value of the property, protecting the lender's security interest and confirming that the loan amount aligns with the property's worth. This is vital for assessing the loan-to-value ratio. Next, we verify assets by documenting savings, investments, retirement accounts, and liquid reserves. This process confirms the borrower's down payment source and their ability to cover emergencies or unexpected expenses. We also analyze employment history, income stability, and review tax returns, pay stubs, along with any other income sources. This helps us confirm that the borrower has sufficient cash flow to support their mortgage payments over time. Credit analysis is another key area. We review credit history, scores, payment patterns, outstanding debts, and public records. This step helps us evaluate the borrower's past financial behavior and their willingness to meet obligations. In summary, underwriting is a comprehensive risk assessment process where lenders evaluate the borrower's creditworthiness, financial capacity, and the property's value. This process is critical for determining whether to approve a loan and under what terms, ultimately protecting lenders from default while ensuring borrowers can afford their mortgage. Let's now talk about how the level of agency authority impacts an agent's ability to bind the principal legally. Essentially, the higher the authority, whether it's universal or general, the more power the agent has, and therefore, the more trust and careful documentation are required. For example, a listing agent who is authorized only to market and sell a single property has limited authority. This means they can only perform specific tasks related to that property. Most real estate agents, however, operate as special agents, which means their authority is limited to facilitating a particular sale or purchase. On the other hand, a property manager is an example of a special agent with broad authority within a specific scope, handling all aspects of property operations. They can perform all acts related to managing that property, acting within the scope of their authority as a general agent for the owner. Now, consider a family member with full power of attorney for an incapacitated person. This is an example of a universal agent who has the authority to perform any and all acts on behalf of the principal, without limitation. Such relationships are created through a general power of attorney and include handling financial, legal, and personal matters. It's important to remember that in typical real estate practice, universal agents are quite rare. When we look at the hierarchy of agent authority, from broadest to most limited, it starts with the universal agent, then the general agent, and finally the special agent. In summary, agency relationships in real estate vary greatly in scope and authority. A universal agent has the broadest power, capable of acting on almost all matters, both personal and business, which carries significant legal implications due to the extraordinary powers involved. Let's start by looking at why sellers often prefer the exclusive right of sale. When they want to maximize the broker's effort, get the most exposure through the MLS, and encourage broker cooperation, this arrangement is ideal. Brokers favor it too because it protects their investment in marketing and guarantees a commission if their efforts lead to a sale. In this setup, the broker earns all proceeds above the seller's desired net price. However, it's important to note that many states discourage or prohibit this type of listing due to potential conflicts of interest. Now, contrasting this with other types, we have the net listing, which is non-exclusive. Here, the seller can work with multiple brokers, but only the broker who finds the buyer earns the commission. Usually, the broker's investment in marketing is minimal. Then there's the open listing, where the broker earns a commission unless the seller finds a buyer on their own, without any help from the broker. The seller retains the right to sell independently and avoid paying a commission if they do so. Moving on to the exclusive agency listing, it's somewhat in between. The broker is entitled to a commission regardless of who procures the buyer, as long as the sale occurs during the listing period. So, how does the exclusive right of sale compare to these? Well, the key difference is that the broker receives the agreed-upon commission regardless of who finds the buyer, whether it's the broker, the seller, or another source. During the listing period, the property can sell from any source, be it a direct buyer approach, the seller's own efforts, or a cooperating broker's client. The broker invests in active marketing, MLS, advertising, showings, and working with other agents to make sure the property gets maximum exposure. And the most important point, if the property sells during the listing term, the broker earns the commission, no matter who procures the buyer. This guarantee incentivizes brokers to put in their best effort because their compensation isn't dependent solely on who finds the buyer. In summary, the exclusive right of sale is the most comprehensive and popular agreement in residential real estate because it ensures the broker earns a commission, motivating them to work aggressively and cooperate fully. While some contracts may be enforceable under certain exceptions, relying on oral agreements in real estate transactions is extremely risky. It's always best to insist on written, signed contracts to protect your interests and to ensure enforceability. There are a few rare exceptions where oral agreements might be enforced, such as promissory estoppel, which applies when one party relies on a promise to their detriment. Another example is part performance, where if the buyer has taken possession, made improvements, or paid substantial consideration, courts may enforce an oral contract. However, these are limited exceptions. In most cases, certain transactions require written documentation, like mortgages and deeds of trust, easement grants, leases exceeding 1 year, options to purchase, listing agreements in most states, and purchase and sale agreements. It's important to understand that oral real estate contracts are generally unenforceable. Even if both parties agree and witnesses are involved, courts will not enforce verbal promises to transfer property rights. That's why written contracts are essential. They must clearly identify the parties involved, describe the property adequately, state the essential terms such as price and payment, indicate the intent to transfer property, and be signed by the parties to be binding. This requirement actually originated in 17th century English law to prevent fraud and perjury. It means that a written document signed by the party to be charged, usually the seller or both parties, is necessary for most real estate contracts. This is all rooted in the Statute of Frauds, a fundamental legal doctrine that mandates certain contracts, especially those involving real estate, must be in writing to be enforceable. This protects parties from fraudulent claims and helps ensure clarity in significant property transactions. So, in summary, always remember that writing is your best protection. Verbal agreements are simply too risky when it comes to real estate. Let's talk about what earnest money is not. First, it's not a tax or fee payment. The deposit doesn't prepay property taxes, closing costs, or government fees. These are separate expenses paid at settlement. It's also not a commission payment. Earnest money belongs to both the buyer and seller, not the broker. The commission is paid from the sale proceeds at closing. Now, what earnest money is not. It's important to clarify that deposits typically range from 1 to 3% of the purchase price. Of course, the exact amount can vary depending on local market customs, the property's price, and how competitive the market is. In highly competitive markets, larger deposits can help strengthen your offer. Buyers should aim for an amount that shows seriousness, but isn't so large that it creates unnecessary risk. The deposit is held in escrow, usually by a broker, a title company, or an attorney, until closing. This neutral third party safely holds the funds, protecting both the buyer and seller until the transaction concludes. While under contract, the seller can accept other offers or keep marketing the property. The earnest money serves as compensation for this opportunity cost if the buyer defaults without a valid reason. If the buyer breaches the contract without valid contingencies, the seller can keep the earnest money as liquidated damages, depending on the contract and state law. The earnest money also signals to the seller that the buyer is serious and committed. Larger deposits often reflect stronger commitment, making the offer more competitive. Finally, making this deposit demonstrates good faith. It's a sign to the seller that you're genuinely interested and intent on completing the purchase. Throughout the process, earnest money provides financial assurance and helps facilitate a smooth transaction. Let's talk about earnest money and how it works at closing. First, it's important to understand that earnest money is never paid directly to the seller. Instead, it's always accounted for through the closing statement. The escrow holder releases these funds according to the closing instructions, applying them as part of the buyer's total financial contribution to the purchase. This means that the earnest money effectively reduces the cash the buyer needs to bring to closing, because it has already been paid earlier in the process. For example, without the earnest money credit, the buyer would need to bring $88,000 to closing, covering an $80,000 down payment plus $8,000 in closing costs. But since $10,000 was deposited as earnest money and credited on the settlement statement, the buyer only needs to bring $78,000. Looking at the buyer's financial position, they have a total cash to close of $78,000, with $8,000 designated for closing costs. The earnest money credit of $10,000 reduces this amount, so the actual down payment required is $80,000, and the loan amount is $320,000 on a $400,000 purchase price. Now, on the closing statement, the deposit becomes part of the down payment or is used to pay closing costs, which reduces the amount the buyer needs to wire or pay by check. The earnest money appears as a credit on the buyer's side, helping to reduce the cash needed at closing. Once the transaction proceeds to settlement, all financial obligations are reconciled on the closing statement. On closing day, the buyer provides earnest money when the offer is accepted, typically 1 to 3% of the purchase price, and it's held by the broker or escrow agent. When the transaction closes successfully, that earnest money deposit is then incorporated into the buyer's overall financial contribution toward the purchase. Understanding how the earnest money is applied is crucial for buyers preparing for settlement. It ensures there are no surprises and that everything is properly accounted for, making the closing process smoother for everyone involved. Immobilité explique également pourquoi les marchés immobiliers sont moins efficaces que les marchés financiers. La découverte d'esprit est plus lente, les ventes comparables sont imparfaites, et il existe des asymmétries d'information parce que chaque propriété est véritablement unique en raison de sa localisation, fixe et permanente. Étant donné qu'une propriété ne peut pas être déplacée vers un marché meilleur ou un emplacement plus favorable, l'investissement immobilier nécessite une analyse approfondie de l'emplacement. L'adage, location, 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 reflète justement la dominance de cette immobilité dans la détermination de la valeur. Les investisseurs ne peuvent pas déplacer des actifs qui sus performances comme ils le pourrient avec d'autres investissements. They doivent soit améliorer la propriété dans sa localisation fixe, soit la vendre en fonction des conditions locales du marché. Cela signifie que l'évaluation d'un bien doit prendre en compte l'environnement immédiat, l'axies, la topographie et les conditions du site, car ces éléments ne peuvent pas être modifiés ou améliorés alors. La réglementation locale, comme les codes de zonage, les règlements de construction et les usages du sol, variant d'une juridiction à l'autre, ce qui influence ce que l'on peut construire et comment la propriété peut être utilisée. Le marché immobilier fonctionne à l'échelle locale, pas nationale, ce qui crée des dynamiques différentes de l'offre et de la demande selon les quartiers, et des disparités de prix même au sein d'une même ville. Aucun du biens en occupant exactement le même espace. Même des maisons identiques dans la même subdivision, different par leur lot, leur vue ou leur proximité avec certains éléments. La valeur d'un bien est intrinsèquement liée à son emplacement géographique. La proximité avec les quartiers résidentiels, les écoles, les centres d'emploi et les commodités devient partie intégrante de sa proposition de valeur. En fin de compte, parmi toutes les caractéristiques qui rendent l'immobilier unique en tant que classe d'actifs, l'immobilité est la plus fondamentale. Contrairement aux biens personnels ou aux actifs financiers, le terrain ne peut pas être déplacé, ce qui donne une importance capitale à l'emplacement dans la valorisation et l'investissement immobilier. Understanding whether a lien is specific or general is really crucial, because it affects how we can pursue collection remedies, the marketability of the property, and even the requirements for title insurance. When we talk about specific liens, these are tied directly to a particular property, providing security for a specific debt related to that property. In contrast, general liens reflect broader financial obligations that can affect all of a debtor's assets, not just one property. Now, specific liens follow the property itself, not just the owner. So if that property sells, the lien usually has to be paid from the sale proceeds. Otherwise, the new owner takes the title subject to that lien. That's why title searches and title insurance are so important. They help identify these liens so they can be cleared before closing. Let's look at some common examples of specific liens. An involuntary specific lien is for unpaid property taxes. These take priority over most other liens and can even lead to a tax foreclosure sale if not paid. On the other hand, a voluntary lien is created when a property is used as collateral for a loan, like a mortgage. This lien attaches only to the mortgaged property and is released once the loan is fully paid off. Another example is a mechanic's lien, which contractors, subcontractors, or suppliers can place if they've provided labor or materials but haven't been paid. This lien attaches specifically to the improved property and must be filed within a set time after the work is done. It's important to note that some liens attach to all property owned by a debtor. These are called general liens. Examples include judgment liens, IRS tax liens, and state income tax liens. They can affect all assets, both real and personal. Conversely, a specific lien attaches only to one particular piece of real estate. Its claim is limited to that property's value, and satisfying the lien requires payment from that specific property. Finally, a lien is essentially a legal right for a creditor to have debt paid from property proceeds if the debtor doesn't pay. It doesn't transfer ownership, but creates a claim against the property, which must be settled at sale or refinancing. Understanding these lien types is key for title examination and ensuring a smooth transaction. Understanding these distinctions is crucial for effective title examination, estate planning, and recognizing how ownership can be lost beyond the usual sale transactions. When we talk about voluntary alienation, we're referring to situations where the owner willingly decides to transfer their property. This includes actions like selling the property or donating it. Voluntary alienation respects the owner's autonomy, meaning they have control over when, to whom, and under what terms they transfer ownership. On the other hand, involuntary alienation happens through legal processes or external circumstances that force the transfer, regardless of the owner's wishes. For example, if someone dies without a will or heirs, the property may pass to the state. This is called escheat. Another form of involuntary transfer is adverse possession, where a long-term trespasser can acquire ownership if they openly, notoriously, and continuously possess the property for a statutory period, usually between 5 to 20 years, depending on the state. Then there's eminent domain, where the government exercises its constitutional power to take private property for public use, but they must pay just compensation. This is involuntary, but it's legally authorized. Similarly, foreclosure occurs when a property is sold to satisfy unpaid debts secured by a mortgage or deed of trust. Again, an involuntary process initiated due to default on loan obligations. To sum up, alienation is all about transferring property ownership. It can happen voluntarily, through the owner's choice, or involuntarily, through legal or governmental actions. Recognizing these distinctions helps us understand how ownership can change hands beyond simple sales. Easements differ from encroachments, which are unauthorized physical intrusions onto a property, and licenses, which are revocable permissions granted to use the land. Unlike licenses, easements run with the land, meaning they stay with the property even when ownership changes, and they are binding on future owners. On the other hand, licenses are personal and temporary, and they can be revoked at any time. That's why it's always important during a title examination to verify the exact locations of easements and any restrictions associated with them. There are several ways an easement can end or be terminated. For example, prescription occurs when the servient owner blocks use for a statutory period, essentially establishing a legal right for the dominant owner. If the purpose of the easement no longer exists, say, the land is no longer landlocked, necessity ends, and the easement can be terminated. Abandonment involves non-use coupled with an intent to abandon the easement. Sometimes, if the same person owns both the dominant and servient parcels, the easement merges and automatically terminates. Additionally, the easement holder can voluntarily relinquish their rights through a release. Easements can also be created or terminated through specific methods. Prior use, for instance, is implied from an existing pattern of use before the easement was formalized. Prescription, as I mentioned, involves long-term adverse use. Necessity is implied when a property becomes landlocked and needs access. When the grantor sells the property but wants to retain some rights, they can do so through a reservation. And a written document, called an express grant, explicitly conveys the easement rights. Understanding how easements are created and terminated is vital for proper property management. Sometimes, landowners or organizations limit development to protect natural resources, wildlife habitats, or agricultural land. These are often preserved through conservation easements, which can be donated to conservation organizations or government entities, often providing tax benefits. To preserve scenic views, property owners might establish view easements that restrict structures or vegetation from blocking sightlines, helping maintain property value. Utility easements are another common type, allowing utility companies to install and maintain infrastructure like power lines, gas pipes, and water mains across private land. They benefit the utility, not necessarily the neighboring property owners. There are also access easements, which grant the right to cross someone else's land to reach a landlocked parcel or a public road. These are known as easements appurtenant, meaning they benefit specific adjacent properties and transfer with the property when it changes hands. At their core, easements are a non-possessory interest in someone else's land. They give the right to use the land for a specific purpose without transferring ownership. They are essential for the functionality of property, enabling access and utility services while balancing the rights of landowners with practical needs. When a property owner voluntarily changes their use to a conforming use or abandons a non-conforming use for a specified period, they typically lose the right to resume the non-conforming use permanently. This is an important point because it means that once these actions happen, the original non-conforming status is effectively extinguished. Let's talk about voluntary termination. If you have an oversized structure, say a building that exceeds current height or setback limits, it can remain on the property, but it cannot be enlarged further. Similarly, if you own an industrial building, like a factory, and the area gets rezoned for office use, you can continue manufacturing there, but you can't add new production lines or build any additional structures. In residential zones, if there's a corner store that existed before the area was rezoned residential, it can keep operating. However, it can't expand its sales floor or increase its operations beyond what was originally permitted. These are typical examples of non-conforming uses that are protected but also limited. It's also crucial to understand what actions are restricted. For instance, you cannot change your use to a different non-conforming use, nor can you rebuild if your building is destroyed beyond a certain threshold, usually around 50%. You also can't intensify the use beyond the original scale, nor expand the building footprint. On the other hand, some actions are permitted. Owners can rent or sell the property maintaining the same use, make minor modifications that don't expand the use, perform routine maintenance and repairs, and continue the existing use indefinitely. Now, regarding owner rights and limitations, owners cannot expand their use, make major modifications, or rebuild if their property is substantially damaged. Ultimately, the use must eventually conform to current zoning regulations. It's important to note that these existing uses can continue despite not fully complying with new zoning laws, thanks to grandfather clause protections. This is what we call non-conforming status, an existing property use that was legal at the time it was established, but no longer complies due to subsequent zoning changes. This process begins when a municipality adopts a new zoning ordinance or rezones an area to a different classification that prohibits the current use. Before that, the property use was established in compliance with existing laws, and proper permits were obtained, making the operation lawful. This entire concept of non-conforming use, often called a grandfathered use, balances property owners' rights with the need for municipalities to implement new zoning policies. It allows existing uses to continue while encouraging eventual conformity. Frictional vacancy is an inevitable part of the rental market, and it's important to include it as a normal operating expense when we're making financial projections. Many people try to aim for zero vacancy, but that often means underpricing units below market rates, which sacrifices income in the process. Instead, our goal should be to minimize frictional vacancy through efficient property management, quick turnovers, and effective marketing strategies. It's not realistic or necessary to eliminate it entirely, but reducing it as much as possible helps maintain profitability. Now, there are several factors that influence vacancy rates. Local market customs, such as standard lease terms and typical vacancy periods, play a role. Seasonal moving patterns and normal absorption rates also impact how quickly units turn over. Market factors like tenant screening processes, lease-up timing, and the usual marketing periods are important, as well as minor renovations between tenants and unit cleaning routines. On the tenant side, reasons for frictional vacancy include changes in lifestyle, education pursuits, family size shifts, job relocations, and housing preferences. These are all common life events that cause tenants to move, thereby creating temporary vacancies. Frictional vacancy itself is generally temporary, but can sometimes last longer in certain circumstances. For example, during economic downturns or recessions, demand drops across the entire market, leading to cyclical vacancy. These situations affect whole markets rather than individual properties and tend to recover when the economy improves. Some vacancies require capital investment and rehabilitation, especially if caused by physical problems, poor property condition, outdated design, or functional issues. These are known as structural vacancies, which typically account for about 3 to 7% depending on the market and property type. Most of the time, vacancy occurs naturally due to market turnover. This is what we call normal or frictional vacancy. Even in balanced markets, some vacancy is inevitable because of the time needed for unit preparation, marketing, and tenant move-in. Understanding these different types of vacancy, especially frictional, is key for accurate real estate market analysis and investment planning. It helps us set realistic expectations and develop strategies that keep our properties competitive while acknowledging that some level of vacancy is just part of the normal market cycle. Accrued depreciation is not the same as the tax depreciation you claim on income tax returns. Appraisers estimate the actual loss in value based on market evidence, while tax depreciation follows arbitrary IRS recovery periods, regardless of the property's actual condition or value. Never confuse these two concepts when performing appraisals or analyzing investment returns. The purpose of tax depreciation is to provide a tax benefit, not to measure the property's true economic value. It's an accounting concept that allows for the recovery of the property's cost basis through annual deductions. These IRS schedules, 27, 5 years for residential and 39 years for commercial properties, are somewhat arbitrary and may not reflect actual value changes. When we talk about tax depreciation, we use a formula. Value equals cost new minus accrued depreciation plus site value. This formula measures the actual loss in property value from all causes, making it a real economic concept based on market behavior and property condition. That's why it's used in the cost approach to value real estate. On the other hand, appraisal depreciation is about external factors beyond the property owner's control, things like declining neighborhoods, nuisances, or zoning changes that cause value loss. These are always incurable because the owner can't fix outside influences. Then we have functional obsolescence, which stems from outdated design or features that reduce the property's utility or desirability. This can sometimes be curable, like remodeling an outdated kitchen, or incurable, like a poor layout that can't be fixed economically. Examples include outdated electrical systems or no central air. Finally, physical deterioration relates to wear and tear, aging, or deferred maintenance, things like worn flooring, peeling paint, or an aging roof. Some of these issues are curable if repairs are economically feasible. Others are incurable if repair costs outweigh the value added. In real estate appraisal, accrued depreciation captures the difference between the reproduction or replacement cost new and the current market value of the property, reflecting all types of value loss. Understanding these three types of depreciation, tax, external, and functional, is essential for accurate cost approach valuations and for making informed investment decisions. Points are tax-deductible for primary residence purchases, but keep in mind that they must be amortized over the loan term if you're refinancing or dealing with investment properties. It's always a good idea to calculate whether paying points makes financial sense for your specific situation and how long you expect to hold the property. Now, regarding negotiability, origination points may be negotiable depending on market conditions and how much competition there is among lenders. Some lenders might even offer no-point loans, though usually at slightly higher interest rates. For example, if a lender charges one origination point, that's $3,000 on a $300,000 loan, and it's meant to cover processing fees. These fees are charged by lenders to cover the costs of processing and originating the loan. It's important to note that points are not prepaid interest. They're more like a fee or profit for the lender. Let's talk about the concept of origination points a bit more. When you do a break-even analysis, you want to compare the upfront cost of paying points to the monthly savings you get from a lower interest rate over your expected period of ownership. Generally, paying points makes sense if you plan to hold the property long enough to recoup those costs through the monthly payment savings. For example, if you pay 2 points, which is $6,000 on a $300,000 loan, to reduce your rate from 7% to 6.5%, you'll see lower monthly payments. Those points are prepaid interest. Each point typically reduces your interest rate by about 0.25%, though this can vary depending on the lender and the market conditions. Now, a quick note on discount points. 1 point on a $300,000 loan equals $3,000. It scales directly with your loan size, regardless of the property value. Similarly, on a $200,000 loan, 1 point is $2,000, and 3 points would be $6,000 in fees at closing. Remember, 1 point is always 1% of the loan amount, not the purchase price. So, it's a straightforward way to measure how much you're paying upfront to buy down your interest rate. In summary, understanding what points are, how they work, and how to analyze their value is key to making informed decisions that align with your financial goals when buying or refinancing a home. Let's talk about how borrowers can avoid PMI or private mortgage insurance. One way is by making a 20% down payment on the home. For example, on a $200,000 home, putting down $40,000 would eliminate PMI. Another option is using piggyback loans, like an 80-10-10, where you finance 80%, take a 10% second mortgage, and put 10% down. Lender-paid PMI is also available, where the lender covers the PMI cost but typically charges a higher interest rate. And for qualified veterans, VA loans offer the benefit of no PMI at all. Now let's look at an example with a $200,000 property and a 10% down payment, which is $20,000. This means the loan amount would be $180,000, making it a 90% LTV, or loan-to-value ratio. Since the LTV exceeds 80%, PMI is required. If the annual PMI rate is 0.5%, that adds up to $900 per year, or about $75 each month, added to your mortgage payment. It's important to understand that you can request to cancel PMI once your LTV drops to 80%, either through your payments reducing the loan balance or through property appreciation increasing the home's value. Legally, federal law mandates that PMI automatically terminates when your LTV reaches 78%. Regarding how PMI works, typically borrowers pay a monthly premium that gets added to their mortgage. The premium rate varies based on your LTV, credit score, and the type of loan, usually ranging from 0.3% to 1.5% annually. And why is PMI required in the first place? When your LTV exceeds 80%, PMI protects lenders from potential losses if you default. It essentially allows borrowers to buy homes with less than a 20% down payment, opening up more opportunities for homeownership while managing the lender's risk. Finally, to calculate your LTV, divide your loan amount by the property's value and multiply by 100. For example, a $90,000 loan on a $100,000 home results in a 90% LTV. Remember, PMI is a crucial tool that helps both lenders and borrowers, but there are ways to remove it once you build enough equity. Understanding these options can help you make smarter decisions on your homeownership journey. Let's take a closer look at how state law influences the use of different instruments in real estate financing. Some states rely solely on mortgages, while others only use deeds of trust, and a few allow both options. The core goal remains the same. The property secures the debt repayment. However, the procedural path that follows a default varies significantly depending on the instrument used. In a deed of trust, the trustee holds bare legal title, meaning they have the legal ownership, but the borrower retains equitable title and possession of the property. The beneficiary, typically the lender, has a security interest. This setup allows for a faster resolution if the borrower defaults, often through a non-judicial process. It's generally more cost-effective for lenders, with foreclosure processes that can be completed in weeks or months, and limited or no redemption rights for the borrower. The trustee conducts the sale according to the trust deed terms, and the process doesn't usually require court supervision. On the other hand, in mortgage states, the borrower keeps both legal and equitable title to the property. The lender, however, only holds a lien interest. When default occurs, the foreclosure process tends to be longer, taking months or even years, and involves court supervision, making it more expensive for lenders. Borrowers typically have statutory redemption periods, allowing them to reclaim the property within a certain time frame after foreclosure. To summarize, the key difference lies in how the property title is held and the foreclosure process. Deed of trust states favor speed and efficiency, while mortgage states prioritize borrower protections, often resulting in longer, court-supervised foreclosures. Understanding these distinctions is crucial for both lenders and borrowers, as they directly impact rights, timelines, and costs. Now, looking at the specific roles in a deed of trust, the trustee acts as a neutral third party holding legal title. The beneficiary is the lender, whose security interest is protected. The trustor is the borrower, who conveys the property to the trustee. This three-party arrangement enables non-judicial foreclosure, which is faster and less costly. In contrast, a mortgage involves just two parties: the mortgagor, the borrower, and the mortgagee, the lender. The borrower pledges the property as security by executing a mortgage document, which creates a lien. Foreclosure in mortgage states typically requires court action, known as judicial foreclosure, which tends to be lengthier but offers more borrower protections. Both instruments serve the same fundamental purpose, pledging property as collateral, but they differ significantly in structure, involved parties, and foreclosure procedures. Recognizing these differences helps us understand the rights and remedies available to both borrowers and lenders within the broader context of real estate financing. When it comes to advertising and promotional materials in real estate, it's crucial to be very careful about the language we use. If we mention specific attractive terms, we are required to disclose all material terms, and that includes both the pleasant and the less favorable details. So, when in doubt, it's best to keep statements general or to provide full disclosures to stay in compliance with TILA and avoid penalties. For example, terms like credit available to qualified buyers, flexible loan programs, competitive interest rates, affordable monthly payments, easy financing terms, or low down payment available are considered vague or general statements. These do not trigger full disclosure requirements and can be used freely in advertising. However, there are specific details that do trigger full disclosure. These include dollar amounts financed, like borrow up to $400,000, or the total finance charge, such as $50,000 total interest, or total cost of $350,000. Also, the number of payments, 360 monthly payments, or 30-year term, or the payment amount, like $1,200 per month, are crucial disclosures. Additionally, the down payment amount, whether it's 10% down or $15,000 down, must be disclosed. When you see specific trigger terms, full disclosure includes these key pieces of information. Remember, TILA's goal is to ensure consumers receive complete information so they can compare credit offers accurately and make informed borrowing decisions. If advertising highlights any specific credit terms, it triggers the need to disclose all material credit terms. This is to prevent deceptive practices, like emphasizing attractive terms while hiding unfavorable conditions. The concept of triggering terms is rooted in the Truth in Lending Act, or TILA, which is implemented through Regulation Z. It's designed to protect consumers by making sure they get clear, transparent information about credit offers. Understanding what constitutes a triggering term helps us stay compliant and serve our clients ethically. In summary, always be mindful about what credit terms you mention in your advertising. If it involves specific figures or conditions, full disclosure is mandatory. If it's more general, you can use that language freely. The key is to provide clear, comprehensive information to help consumers make the best borrowing decisions. When it comes to dual agency situations, buyers and sellers should seriously consider consulting with attorneys or seeking independent counsel before making any strategic decisions. The reason is that a dual agent's role is to act as a neutral facilitator, which means neither party receives the full advocacy they would have if they had independent representation. This can create some significant challenges. Some states actually prohibit dual agency entirely, while others allow it, but only with informed consent from both parties. There are also states that have developed models like designated agency or transaction broker arrangements to better manage conflicts of interest. It's essential to always check your specific state's regulations regarding dual agency to ensure you're acting within the law. Let's talk about the risks involved. Increased liability exposure for the agent is a big concern because their fiduciary duties, like loyalty and confidentiality, are often compromised. There are barriers to sharing confidential information, and agents can't really give full advice on strategy or pricing. Negotiating becomes tricky too, since there's an inherent conflict of interest. Agents can't advocate fully for either side. On the other hand, there are some potential benefits. Because the agent knows both parties' positions, they might help streamline coordination, scheduling, and even leverage negotiations for a quicker process. Communication barriers are reduced, and having a single point of contact could potentially speed things up. However, it's important to remember that a dual agent's role is limited. They can facilitate the transaction by providing factual information, managing paperwork, and coordinating inspections, but they cannot give strategic advice or negotiation tactics to either party. Their role is more about facilitating than advocating. Also, the agent must immediately disclose the dual agency situation in writing to both parties. This disclosure should clearly explain the limitations on their role and obtain written informed consent before proceeding. Dual agency can arise in several ways, such as when a listing agent's buyer-client becomes interested in the agent's own listing, or when two agents from the same brokerage represent opposing parties. Even with different agents, in-house transactions at a brokerage level can create dual agency. In summary, dual agency occurs when one agent or brokerage represents both the buyer and seller in the same transaction. This setup inherently involves conflicts of interest, so handling it carefully, with full disclosure and informed consent, is crucial. Remember, the agent's role shifts from full advocacy to facilitator, and understanding these distinctions helps ensure ethical and legal practice. While there are some limited exceptions, such as part performance or promissory estoppel, Relying on oral real estate agreements is extremely risky. It's always best to insist on written, signed contracts for any property-related transaction. Doing so ensures your legal protection and makes your rights enforceable. Verbal agreements for property sales, no matter how clear or witnessed they are generally unenforceable in court. Courts will not compel performance or award damages based on oral property contracts, which leaves parties without legal remedies despite their agreement. When it comes to real estate, the focus is primarily on property-related contracts. These include contracts involving executor responsibilities, prenuptial agreements, promises to answer for another's debt, contracts not performable within 1 year, and the sale of goods over $500 under the UCC. Other covered contracts include leases exceeding 1 year, easement grants, rights of first refusal, options to purchase, real estate listing agreements. Most states require these: mortgages, deeds of trust, deeds conveying ownership, and purchase and sale agreements. Now, contracts that require writing under the statute of frauds include those involving real property interests. To be enforceable, these contracts must be in writing and signed by the party to be charged, typically the party against whom enforcement is sought. This requirement protects against enforcing non-existent or disputed agreements. The core reason behind this is historical, dating back to 1677 in England with the Act for Prevention of Frauds and Perjuries. It was designed to reduce false testimony about important agreements. Essentially, it prevents parties from fabricating contract terms without written proof, which helps reduce litigation and perjury. The statute of frauds is a foundational legal principle. It states that certain contracts must be evidenced by written documentation and signatures to be legally enforceable. This centuries-old doctrine protects parties from fraudulent claims and ensures clarity in significant transactions, especially those involving real property. In summary, always remember that written and signed contracts are your best protection in real estate dealings. Relying on oral agreements is just too risky and often unenforceable. Let's go over some key points about prorated items at closing. First, the overall idea of proration is to fairly divide expenses between the buyer and seller based on their periods of ownership. This ensures that each party pays only for the time they own the property. Next, we determine which expenses are involved. These can include property taxes, homeowner association fees, utilities like water and sewer, fuel, rent, and insurance premiums. We need to identify which of these are paid annually or periodically, and then divide them accordingly. Once we've identified the items, we calculate the daily rate by dividing the annual or periodic amount by 365 days, or sometimes 360, depending on the market. This helps us allocate costs precisely based on the ownership period. Then, we count the number of days each party owns the property during the billing cycle. Usually, the closing day is charged to the buyer unless agreed otherwise. Finally, we apply the credit or debit on the closing statement. For example, if the seller paid property taxes up front for the entire year, the buyer would owe their share, and the seller would be credited for the portion they've already paid. Conversely, if the seller hasn't paid taxes yet, they owe the buyer their share. Remember, for many expenses like fuel or HOA fees, prorating ensures a fair and transparent transaction. It reflects the principle that each party should only pay for what they actually use during their ownership period. On this slide, we're exploring the idea that multiple parties can hold different kinds of interests in the same property at the same time. For example, one person might own the property outright, while others hold easements, restrictive covenants, or liens. This concept is often called the bundle of rights, and it really demonstrates how property can be divided into different rights and interests. Now, it's important to understand the difference between possessory and non-possessory interests, because this affects how properties are valued, financed, and insured. Possessory interests give you the right to occupy and physically use the property, like a fee-simple ownership or a leasehold estate. Non-possessory interests, on the other hand, don't grant possession but still encumber the title. These need to be disclosed, but they don't prevent the transfer of ownership. Buyers should always review these carefully to understand any use limitations or obligations attached to the property. Take, for example, the right to enter someone else's land to extract natural resources like minerals, timber, oil, or crops. That's a non-possessory interest called a profit apprender. It allows the holder to access and use the land for specific purposes without owning it. Another example is a lien, which is a legal claim against the property used as security for a debt. The owner keeps possession, but if the property sells, the lien holder has a claim to the proceeds. Then we have covenants. These are promises related to property use that run with the land and bind future owners. Restrictive covenants might limit certain activities, like prohibiting commercial use, while affirmative covenants might require actions, such as maintaining a fence. Easements give someone the right to use another person's property for specific purposes, like driveway access, utility lines, or drainage rights. They don't grant possession, but do allow use. To clarify, these non-possessory interests include licenses, which are revocable permissions, profits, which give the right to extract resources, liens, which are financial claims, restrictive covenants, which set use restrictions, and easements, which permit crossing or using land. These rights provide specific property benefits without giving possession. The holder can't exclude others from the property, but can enforce their use rights or restrictions. On the other hand, possessory interests include fee simple conditional, leasehold estates, life estates, and fee simple absolute ownership. These grant the right to occupy, possess, and physically use the property. The owner has exclusive control and the right to be present on the land. In summary, understanding whether an interest is possessory or non-possessory is fundamental to analyzing property rights and making informed decisions about property transactions. Let's take a closer look at new urbanism, which emphasizes traditional neighborhood design. It promotes diverse housing options, a mix of uses, walkable streets, public spaces, and aims to reduce our dependence on automobiles. The idea is to create communities where everything you need is within walking distance, fostering a sense of connection and accessibility. In contrast, smart growth focuses on compact, mixed-use, transit-oriented development. It aims to preserve open space and encourage walkability by making efficient use of existing infrastructure. Both approaches seek to counteract the problems associated with urban sprawl by promoting smarter development patterns. Speaking of alternatives, urban sprawl leads to several issues. For example, health impacts from a sedentary lifestyle become more common when neighborhoods aren't walkable, and social isolation can increase as communities become more car-dependent. Limited transit options and reduced walkability mean longer commutes and less opportunity for community interaction. On the environmental side, sprawling development causes watershed degradation and increases impervious surfaces, which can lead to more vehicle emissions and pollution. It also results in the loss of farmland and natural habitats, threatening local ecosystems. Economically, urban sprawl is inefficient. It uses existing infrastructure poorly, raising household transportation costs and increasing municipal service expenses. The higher infrastructure costs per person, combined with inefficient land use, strain city budgets and resources. When we consider the broader impacts, sprawl extends development beyond existing infrastructure by leapfrogging into rural areas, often converting farmland and open space into built-up areas. This peripheral growth typically involves strict separation of residential, commercial, and employment zones through single-use zoning, which means people need to travel far between home, work, and shopping. This separation makes neighborhoods less walkable and public transit less effective, leading to increased vehicle miles traveled and traffic congestion. Furthermore, low-density development, characterized by single-family homes on large lots, consumes land inefficiently. Population density often falls below 5 to 7 units per acre, requiring extensive infrastructure for relatively few residents. Urban sprawl, therefore, has significant implications for infrastructure, the environment, quality of life, and municipal finances. Let's talk about highest and best use analysis, which is inherently dynamic. Market conditions, zoning updates, infrastructure improvements, or neighborhood changes can all shift what the optimal use of a property might be. That's why regular reassessment is crucial. It helps ensure that the property's use continues to align with the goal of maximizing value. Now, when evaluating whether to retain an existing structure, it must contribute value that exceeds the combined costs of demolition and the site's value as vacant land. If the site value as a vacant lot is higher than the value of the improved property, then tearing down and redeveloping makes more sense. In fact, demolition and redevelopment are often the optimal choice, especially if renovation or conversion doesn't add enough value. Renovation can sometimes create more value, but the key is to determine whether the current use remains the highest and best use. For existing buildings, we need to analyze several factors. First, is it maximally productive? For example, a 6-story mixed-use building with ground-floor retail and upper-floor apartments often generates the highest land value because of its efficient use of space. Second, is it financially feasible? Multiple options, office, retail, apartments, or mixed-use, may be viable, but we need to pick the most financially productive one. Third, is it legally permissible? Zoning regulations need to allow these uses, say, up to 8 stories for commercial or mixed-use buildings. And fourth, is it physically possible? The site must be level, of adequate size, with good utility access and suitable soil conditions. Constraints like steep slopes or wetlands might limit what can be developed. When we look at a vacant downtown corner lot, these same principles apply. Among all physically possible, legally permitted, and financially feasible options, the highest and best use is the one that produces the greatest return, maximizing land value through the right combination of development intensity and property type. Remember, the use must generate enough income or utility to justify the investment. Development costs, operating expenses, and financing must align with the expected revenues. Sometimes, multiple options are feasible, but we need to choose the most productive one. Legal compliance is also essential. Even if a use is physically possible, it must adhere to zoning, building codes, and environmental restrictions. Illegal uses are not considered highest and best. Physically, the site size, shape, topography, soil, and access constraints also influence what's possible. For example, steep slopes or wetlands might prevent certain types of development. In conclusion, the highest and best use of a property, whether vacant land or improved, is the most probable, legal, feasible use that results in the highest value. This analysis is fundamental because it guides valuation and development decisions, ensuring we make the most of each property's potential. Carrying costs directly impact the profitability of holding a property over time. When these costs are high, investors tend to develop or sell more quickly to avoid accumulating too many expenses. Conversely, low carrying costs give investors the patience to wait for the right market conditions before making a move. That's why, in development feasibility analysis, we need to consider carrying costs throughout the entire construction and lease-up periods. Extended delays in development or sale can significantly increase the total project costs because of these accumulated expenses. Now, it's important to understand that potential profit from a future sale isn't considered a carrying cost. Instead, it's an anticipated return on investment. When we talk about capital gains, we're referring to the profit made from the sale of the property, which relates to the investment outcome, not ongoing expenses. Also, capital gains are more of an accounting concept used for tax purposes. They're not actual cash outlays. Tax depreciation, for example, helps reduce taxable income, but it doesn't require us to write checks or pay cash. Next, income generated from the property, such as rental income, is considered revenue, not expense. If rent is coming in, it can offset some of the carrying costs, but it's important to remember that rental income itself isn't a cost of ownership. There are also several costs that are not considered carrying costs. For example, legal and professional fees, things like attorneys, accountants, property managers, or advisors, are related to property holding or compliance, but aren't part of the ongoing carrying expenses. Similarly, if the property is within a community association or improvement district, there may be mandatory fees called HOA or special assessments. These fees cover shared amenities, roads, or services, regardless of whether the property is developed or vacant. If the property was purchased with financing, then the monthly interest payments are a significant part of carrying costs. While the principal payments help build equity, the interest is purely an expense that we need to account for. Maintenance costs are also part of carrying costs. They include landscaping, trash removal, fence repairs, weed control, and vandalism prevention. Even vacant land requires some basic upkeep to prevent violations and preserve value. Insurance is another key component. Property insurance protects against risks like fire or liability. If the property is financed, lenders usually require this coverage. The cost can vary based on location, value, and coverage level. And finally, property taxes are assessed annually by local governments based on the property's value. These taxes must be paid regardless of whether the property is being used or generating income, making them typically the largest component of carrying costs. In summary, carrying costs represent the ongoing expenses of holding or owning property over time without producing income. Understanding these costs is crucial for land investors, developers, and anyone holding land while waiting for development or sale. Being aware of these expenses helps us make better investment decisions and plan more effectively for the future. Title insurance is issued after a comprehensive title search is conducted, examining public records for any defects. This search helps identify most potential problems before closing, allowing time to resolve them. The insurance then covers the small risk that some issues might be missed, such as hidden defects or errors in the records. Without title insurance, buyers risk losing their entire property investment if unknown claims or issues arise later. It's important to note that title insurance is usually required by lenders, mainly to protect their interests. It benefits the lender by ensuring their security interest remains enforceable, preventing issues like loss of lien enforceability, title defects reducing collateral value, priority disputes with other lenders, or invalid liens that could jeopardize their position. The coverage typically equals the loan amount and decreases as the loan principal is paid down. Since nearly all mortgage lenders require it, it's a critical safeguard for them. For buyers, while title insurance is optional, it's highly recommended. It protects against risks like fraud in the chain of title, unknown heirs claiming ownership, errors in deed recording, forged documents, or claims from previous owners. Essentially, it safeguards the buyer's investment by covering the purchase price and remains in effect as long as they or their heirs have an interest in the property. There are two types of policies: the lender's policy, which we just discussed, and the owner's policy, which is optional but strongly advised. The owner's policy covers issues like future claims, known defects disclosed before closing, unrecorded liens or easements, zoning violations, boundary disputes not visible from public records, environmental contamination, and governmental takings occurring after the policy date. Remember, a one-time premium paid at closing provides coverage for the entire ownership period. If a covered defect is discovered, the insurer will cover legal defense costs and compensate for financial losses up to the policy limits. The purpose of the policy is to protect against specific title defects, such as forged deeds or documents, undisclosed heirs claiming ownership, incorrect property descriptions, fraudulent impersonation of owners, errors in public records, invalid divorces affecting prior transfers, and undisclosed easements recorded before the policy. Title insurance is essential because it protects both property buyers and lenders from financial loss due to defects in title that existed before the policy was issued but were unknown at the time of purchase. Unlike other types of insurance that cover future risks, title insurance specifically safeguards against past events that could impact ownership rights and the security of the property. Let's talk about the discount rate selection and its impact on DCF valuation. Essentially, the higher the discount rate we choose, the lower the present value of future cash flows will be, and vice versa. Small adjustments in our assumptions around this rate can significantly influence investment decisions, so it's crucial we justify our choice carefully. We need to base this on market evidence and a thorough risk assessment. Now, when we look at the relationship between NOI and property value in a single period analysis, it's pretty straightforward. Higher NOI means higher value. But it's important to remember that this approach doesn't explicitly account for future cash flow changes, growth, or the time value of money over multiple periods. It's related to, but distinct from, the discount rate itself. Moving on to some specific components, the capitalization rate reflects the cost of borrowed funds. It's what lenders require as a return. This rate is specific to debt financing and is typically lower than the discount rate because it's secured by collateral. Speaking of borrowing, the mortgage interest rate is different from related rates like the capitalization rate. Inflation plays a big role here. Anticipating inflation is critical because it erodes purchasing power. To get real returns, our discount rate must be higher than the rate of inflation. In environments with higher inflation, we generally need to apply higher nominal discount rates. When we talk about the risk premium, this is the additional return investors demand for taking on investment risk. This premium varies depending on factors like property type, location, tenant quality, leverage, and overall market conditions. The higher the uncertainty, the higher the premium. The risk-free rate, on the other hand, is the return you can get from safe investments like U.S. Treasury securities. It compensates for the time value of money without adding any risk premium. Currently, this rate fluctuates based on Federal Reserve policies and inflation levels. Bringing these together, the discount rate components must meet or exceed what investors require as a return, considering the opportunity cost of other similar investments. It reflects market expectations and the availability of capital. Higher-risk investments naturally demand higher discount rates to compensate for the added uncertainty. For example, stable tenants with long leases might justify lower rates than speculative developments with uncertain income streams. And finally, the concept of the time value of money reminds us that money today is worth more than the same amount in the future because of its earning potential. The discount rate quantifies this preference, rewarding investors for delaying receipt of cash flows. In summary, the discount rate is a vital part of DCF analysis. It encapsulates the required return, risk, inflation expectations, and market conditions, all of which ultimately influence our property valuations. Understanding these components helps us make more informed, confident investment decisions. Let's take a closer look at the protected classes under the Fair Housing Act. Many states and localities go beyond federal law by adding their own protected classes. Common additions include sexual orientation, gender identity, source of income, marital status, and age. It's crucial to always comply with the most restrictive applicable law, especially when federal, state, and local protections differ. Violating these protections can lead to severe penalties, such as fines, damages, and even license suspension. It's important to note that, federally, only familial status, meaning families with children under 18, and senior housing exemptions are protected. Some states have added protections for age as well. When it comes to screening criteria, landlords can consider legitimate financial qualifications like credit scores, bankruptcy history, and rental payment records. However, discrimination based on employment type or income source is permitted, though some states have exceptions for Section 8 vouchers. Now, let's review what is not protected. For example, certain protections were added in 1988, including protections for families with children and pregnant women. Adult-only restrictions are generally prohibited unless they qualify as senior housing. Regarding familial status, this protection covers families with children under 18 and pregnant women. It also prohibits adults-only restrictions unless the housing qualifies as senior housing. Protection for disabilities was also added in 1988. This means landlords can't discriminate against individuals with physical or mental disabilities. They are required to provide reasonable accommodations and modifications, and this includes service animals. National origin protection prevents discrimination based on country of birth, ancestry, or culture. It also covers language requirements used as pretexts for discrimination. Protection based on gender, including sexual harassment and gender identity, is also part of the law. This includes pregnancy, childbirth, and related conditions. Religion is protected too, covering discrimination based on religious beliefs, practices, or affiliations. This even includes atheism and non-traditional beliefs. Color protection relates to skin color or complexion, which can sometimes differ from racial classification. Discrimination based on color is prohibited. Finally, racial discrimination, based on racial background, ethnicity, or ancestry, is strictly forbidden. This includes steering, blockbusting, and discriminatory advertising. Remember, the Fair Housing Act, enacted in 1968 and amended in 1988, is designed to prevent discrimination in housing transactions based on these protected classes. Understanding these protections is essential for practicing ethically and legally in real estate. Let's take a closer look at the different options available when a homeowner faces financial hardship. One option is a deed in lieu, where the borrower voluntarily transfers the deed to the lender. This can help avoid the lengthy sale process, but it's important to remember that it still impacts your credit. Another option is a traditional sale, where the property is sold for more than the debt owed. In this case, the borrower can walk away with any remaining equity or at least break even. Then there's foreclosure, which is an involuntary legal process. The lender takes possession of the property and sells it at auction. This option tends to be more damaging to your credit score and can have long-term consequences. It's also important to understand how these options differ. For instance, with a short sale, the lender agrees to accept less than the full amount owed, often because the borrower is facing hardship. But keep in mind that junior liens or secondary loans must also agree to the terms, and there may still be a deficiency judgment if the sale doesn't cover all the owed debt. Credit damage is inevitable, but it might be less severe than a foreclosure. However, there are complexities, like multiple lien holders, which can make approval more challenging and lengthy. Plus, there could be tax consequences if debt is forgiven. From the lender's perspective, a short sale can be advantageous because it offers a faster resolution than going through foreclosure and can reduce costs like maintenance and legal fees. It also allows the lender some control and dignity, with the possibility of forgiveness of the remaining debt. For the borrower, a short sale can be a way to avoid more severe credit damage associated with foreclosure. It typically involves a quicker process, and if successfully negotiated, it can help close the transaction with the lender receiving net proceeds. The remaining debt might be forgiven, depending on state laws and the agreement. The process involves several steps. First, the borrower requests approval by providing hardship documentation and property valuation. Then, the lender evaluates whether a short sale makes financial sense compared to foreclosure, considering costs and timing. Once approved, the property is listed for sale, but all offers require lender approval, which can sometimes take months due to review procedures. Finally, the lender reviews the purchase offer, assesses buyer qualifications, and negotiates closing terms. This collaborative process aims to reach an agreement that benefits both parties, avoiding the longer, more costly foreclosure process, and providing a potentially more favorable outcome for everyone involved. Let's take a closer look at amortization and how it benefits both borrowers and lenders. Amortization helps borrowers by enforcing a structured savings process and offering predictable monthly payments, which makes planning easier. At the same time, It ensures lenders receive full repayment with interest over time. Understanding amortization schedules is key because it allows borrowers to see their long-term costs, evaluate the advantages of prepaying, and track how much equity they're building in their property as payments progress. Now, a crucial point to remember is that in many cases, the payments made don't cover the full interest charges initially. Any unpaid interest can actually be added to the principal, which causes the loan balance to grow over time. This situation might require a recalculation of payments down the line, or even a lump sum payment to catch up. This brings us to negative amortization, where regular payments don't fully cover the interest, leaving a larger remaining balance that must be paid later, either through refinancing, paying a lump sum, or selling the property. Next, let's talk about balloon payments. In these cases, payments only cover the interest, so the principal stays the same during the interest-only period. When that period ends, the borrower needs to make a large balloon payment or refinance to pay off the remaining balance. Interest-only loans are a common example of this. During the interest-only period, the payments are lower, but once it ends, the full principal must be repaid, often through refinancing or a lump sum. Now, contrasting other payment structures in a fully amortizing loan, you'll notice that over time, the portion of each payment going toward principal increases, while interest decreases. Despite these shifts, the total annual payment stays roughly the same, say, around $22,754 in our example. Early on, payments mainly cover interest because the outstanding balance is high. As you continue paying, more of each payment reduces the principal, and interest decreases accordingly. By the end, the final payment is almost entirely principal, and the loan balance drops to zero. When that happens, the lender releases the lien, and the borrower owns the property free and clear. Throughout the loan term, as the principal decreases, the interest portion of each payment also declines, and the principal portion increases, all while maintaining a consistent total payment if it's a fixed-rate loan. So, in summary, amortization is a systematic way to pay off a loan gradually, building equity and ensuring full repayment by the maturity date. It's a fundamental concept that underpins most mortgage structures and helps both parties understand their long-term financial commitments. Let's talk about gross leases, which are quite common in residential rentals and multi-tenant office buildings, where dividing up individual tenant expenses isn't really practical. In contrast, retail and single-tenant commercial properties tend to use net lease structures, where tenants pay for their operating expenses directly or reimburse the landlord. Now there are different types of net leases. The triple net lease, or NNN, is where the tenant pays rent plus all operating expenses, think taxes, insurance, and maintenance, so the landlord only receives the rent. The double net lease, or NN, shifts a bit, with tenants paying rent plus property taxes and insurance, while the landlord takes care of maintenance. Then there's the single net lease, N, where tenants cover rent plus property taxes, and the landlord handles insurance and maintenance. When we compare gross leases to net lease structures, one key point is that gross leases can make passing through cost spikes more difficult, since the landlord absorbs those increases. They also demand higher management effort and carry inflation risk without escalations, meaning any expense increases are absorbed by the landlord. On the upside, gross leases simplify relationships with tenants because the rent is predictable. There are no surprises. Landlords might also be able to negotiate higher rents and benefit from operational efficiencies and better control over property maintenance. From the landlord's perspective, gross leases can sometimes mean subsidizing other tenants' usage because they can't control expense management as tightly. They don't get to benefit directly from cost savings, and the rent tends to be higher than in net leases to cover the included expenses. For tenants, gross leases offer simplicity, usually a single payment each month, making budgeting straightforward. The landlord handles all maintenance, and there's no surprise in expenses, giving tenants predictable occupancy costs. However, sometimes tenants might be responsible for interior utilities, especially in modified gross leases. Regarding responsibilities, tenants typically cover property taxes, building insurance, structural maintenance, CAM charges, utilities, management, repairs, and capital improvements. Meanwhile, landlords maintain control over the property's upkeep and service levels. To sum up, a gross lease, also called a full-service lease, means the landlord pays all operating expenses and the tenant just pays a fixed rent. This setup makes it easier to budget and provides predictability, which is why it's common in residential and many office leases. Overall, gross leases offer simplicity and stability for tenants, and for landlords, they provide a predictable income stream, although they do absorb more expense risk. Understanding these differences helps us choose the right lease structure for each property and tenant situation. After completing the reconciliation, I prepare the formal appraisal report. This report documents the entire valuation process, including the methods used, data sources, analysis, and ultimately the final value conclusion, along with the supporting rationale. Reconciliation is a crucial step because it demonstrates the appraiser's professional competence and judgment. The final value opinion must be convincingly supported by a thorough analysis, with a clear explanation of why certain approaches were given more or less weight. This transparency helps report users understand and evaluate the reasoning behind the conclusion. It's important to remember that reconciliation aims to develop an objective value opinion, not to simply meet client expectations or reach a predetermined number. The final opinion should always be supported by logical analysis, and we cannot just pick a number outside the range indicated by our approaches without compelling justification. Reconciliation is not arbitrary. It requires professional judgment rather than mechanical calculation. For example, averaging the results of different approaches without considering their reliability and appropriateness would be inappropriate. Now, what reconciliation is not, it's not a one-size-fits-all process. It doesn't mean applying the income approach to properties that don't generate income, or relying solely on sales comparison if there are few comparable sales. For some property types, like special-purpose properties, the primary approach might be the cost approach to support land value or new buildings, with sales comparison as secondary. For income properties, the income approach is primary because buyers focus on cash flows, but the cost approach can be secondary for verifying new construction, and sales comparison might be secondary due to abundant comparable sales data. For single-family homes, the key is to arrive at a single value or a supported range, based on reasoned judgment rather than simple averaging. When we conduct reconciliation, we consider the strengths and weaknesses of each approach, the quality of data, the comparability of the properties, and market participant behavior. Approaches that are more reliable should carry more weight in our final conclusion. We evaluate which methods are most applicable and reliable given the property's type, intended use, and available data. Each approach provides a different perspective, and we review these to determine their indications. Ultimately, reconciliation involves examining the results from all relevant approaches, weighing their reliability, and forming a final value opinion. It's about making a reasoned judgment, integrating multiple perspectives into a coherent conclusion, rather than just averaging numbers. The goal is to arrive at a single, well-supported value or a reasonable range, with a clear explanation of the rationale behind that conclusion.